on behalf of GIBS, the Center, CAM, Graphene. It's wonderful to welcome you here. More often than not, when hearing about tax jurisdictions, tax regulations, our temptation, and I'll speak for us collectively, is to head down rabbit holes and worry about the second decimal place. When we got into the conversation with Graphene and Michael talking about this program this morning, it struck me that it might equip us to first just step back and get a sense of perspective on why this matters so much. And thinking of some of the headline-grabbing events. Inflation, yesterday Citigroup comes out with certainly a headline-grabbing forecast where they talk about inflation in the UK going to 18.6% early next year. This is an extraordinary number by any measure. And we already have inflation in the UK running at 10, Germany, Europe running at 9, the US running at 8. So inflation has brought a brand new face to capital markets and the world of CFOs and CEOs. That brings bracket creep into the conversation. What happens if marginal tax rate payers get pulled into higher brackets simply because of inflation? Alongside this challenge of inflation, well, the pointy end of inflation becomes the so-called cost of living, no, not so-called, becomes the cost of living crisis. There's nothing so-called about it. The cost of living crisis. That's the pointy end of inflation. Along with that, we have a world of sagging economic growth rates and pushing elevated conversations about tax rates into lower growth tends to take growth lower, not higher. So that might be a headwind, or this conversation might be a headwind rather than a tailwind. Behind that, we have rising inequality, that the world's Gini coefficient sits more unequal today than any time in history. And that then takes us into the discussion about the haves, the have-nots, tax evasion, tax erosion, tax dodging, tax jurisdictions, zero tax rates in the Channel Islands, and so on. How come some have and others don't? And what's fair in this landscape? What's fair and equal? And then all of that against a backdrop, if you have low growth, cost of living crises, elevated inflation, there's a call on governments to fix things. Governments must do something to fix it. Well, here comes another face of this fiscal discussion, which is the very elevated debt and the fiscal pressures that governments find themselves in. The fiscal pressures because of COVID, where many governments stepped into the spending equation, offering wage support, furlough, social benefits to get people through what we could now call the 2 years of COVID, that peak pandemic period. And that leaves many big governments with extremely elevated debt. The big tech guys that have been accused of finding tax jurisdictions, getting very, very low tax rates, and we find some of the investment heroes of the last 5 years are also the tax shy. Maybe that's a polite word. With Amazon coming in with an average tax rate of 12% versus the US tax rate of 21%. Meta, formerly Facebook, even shyer, 10% versus the US base of 21%. So where's the other half gone? And is it, as they suggest, because of complicated tax rules and different jurisdictions, or is it something else? And what might this mean for all of us in this room? At the other end of the spectrum, you have the likes of Anglo-American, Philips, who report tax at the country level, and by that suggestion, lead the way in what others should be doing. So that's the backdrop to this morning's conversation. And it's my incredible pleasure to welcome Michael to address you. I won't spend time going through bios and CVs. That's available to you. If you didn't know his bio, you wouldn't be here. But here is one of the leading authorities on transfer pricing to tell us about what this means, why 137 have signed up, why South Korea and South Africa are sluggish, and what all of this might mean for us.
I would like you to imagine for a moment a CFO of a large listed multinational group operating across multiple different countries. Now, the CFO has been tasked for the past 10 years to try to achieve after-tax or maximize after-tax return on investment for the group. Sounds like a very normal, responsible thing to be targeting. The CFO sleeps pretty well at night because over the last several years they've worked very carefully on their transfer pricing, looking to see is where the profit that I'm earning, is there real substance in terms of the people that are in those different jurisdictions. Now, the year is 2024, and imagine the surprise on the CFO's face when the head of tax walks in and says, we've been running some numbers, and we realize that the effective tax rate for the group is actually it's 2% higher than it was the previous year. And the CFO looks, and in his calmest, nicest, most gentle voice, he responds by saying, well, what is this once-off event that's triggered this? To which the head of tax says, well, actually, it's not a once-off event, it's structural changes that have been taking place. And that, in essence, is what we're talking about here this morning. So, what I've found in this whole discussion on Pillar 1 and Pillar 2, and all the associated debate on digitization and how to tax it, is there's three groups of people. There's the group of people that have read the headlines, global minimum tax, global tax deal. And they're kind of wondering, what does this mean for my business? Notably, we've had a number of clients approach us saying, in this category, please can you just unpack for us what the implication is for my business. Then you get the group of people who, they've been very engaged in the debate, but because it's been going on since about 2017, there's a bit of fatigue involved. And I've noticed that here in South Africa and in Europe and in the US, there's been a lot to take in. We started here focusing on the big tech companies that Adrian referred to, and now it's morphed in many different ways. So there's been a lot of moving parts, and that's led to, in some ways, a bit of fatigue around this. And then we get the group whose heads are literally exploding with all the information. They've tried their best to keep up to date with all the details. So I'm going to try to share an economist's view on Pillar 1 and Pillar 2. There's some really, really clever people in the room who can advise on some of the intricacies of this, but I'm going to try to look at a macro perspective, looking at what's the impact for companies and for countries in South Africa and elsewhere on the continent. It's always helpful to me to remember that it was the G20 that commissioned the project on base erosion and profit shifting to see what could be done in this regard. And the objective is to look for globally fair, sustainable, and modern international taxation system. And this has been looked into in two categories, Pillar 1 and Pillar 2. So there's a very, very significant amount of backing for this project. And in many ways, if we've got the G20 that are driving this, the project really is too big to fail. Another way of looking at what it's trying to achieve is that it's looking to ensure that there's a neutral and equitable way of taxation across all forms of business, whether it's on e-commerce or across the conventional forms of business. So you shouldn't have tax arbitrage dependent on the way that you conduct your business. When we consider the extent and the potential impact of this. Now, these are some numbers that the OECD has put out. They say that for Pillar 1, the expectation is it's going to result in a reallocation of profit equivalent to a minimum, or to at least $125 billion. So that's the profit that will be reallocated to market jurisdictions, and then there'll be the tax on that. Pillar 2 is estimated to result in an extra $150 billion of tax to be earned from low tax countries. So truly a very significant impact on the global economy. What's really happening here is there's going to be a creation of new taxing rights in market jurisdictions. What's different this time round, because we've had this in other instances, but what's different this time round is there's new taxing rights being created where there was no form of the historical form of substance. Previously, we'd create substance of where activities were performed or where someone is based. But now there's substance being based where there's a market jurisdiction. You might not be physically present there, you might not have people there, but there's a presence being created there. So the question is, how did we get here to this really significant development in the taxation world? Now, there's a few trends that really led to this. Over the past several decades, there's been a rise in the rate of digitization. And we see that businesses operate differently. Various aspects of businesses work differently. People manufacture differently. People sell differently. There's e-commerce that takes place. We can be standing here in GIBS and order something in Germany from a retail store in Germany. It's how things have changed. People can work remotely. And manufacturing. I was very fortunate the other day to see some robots in action. And products are produced very, very differently. So that's the one trend. Another trend is there's digital identities that have been created. Now, what's interesting there is if you look at some of the social media platforms, there's value that's created in a particular market, even though the platform might not have people there. Or where they do have some people, there's considerable value being created among us in this room because of our interaction on the social media platform. So what we've got here is a chart that shows the growth in the Bitcoin blockchain. It's not the value of Bitcoin, but the Bitcoin blockchain over a period of time. And you can see the considerable growth in the scale of this blockchain and the extent of digital identity that's being created. Another interesting dynamic that's happened, and this talks a lot to what Adrian was alluding to, the social pressures that have taken place and the need for countries to raise finance. And we actually ran a webinar series in July 2020 where we looked at several of the significant global crises over the past 100 years. Without fail, after every major global crisis, there was a significant change in the international tax landscape, whether it would be World War II, whether it be the oil crisis in the crisis in the 80s, the global financial crisis, and COVID, that was inevitable. And the reason is these crises have resulted in countries having to raise additional funds and looking, to say, well, our economies are in dire straits. We need money for social reform and for social welfare, but we need money for capital expansion. We need to focus on the multinationals that seem to be doing really well. So what we have here is an illustration of the increase in the number of mutual agreement procedures. So it's basically where different revenue authorities, they argue on whose allocation of a multinational's profit how they're going to cut and dice that. So you can see the extent of disputes in this regard, and by way of the proxy on mutual agreement procedures, has also increased over time. So let's now jump into this Pillar 1 and Pillar 2. And what is Pillar 1 and Pillar 2? At a high level, so Pillar 1 involves creating this new taxing right. Now, it applies to the world's largest organizations. So it's companies with a consolidated group turnover of more than 20 billion euros. Now, we've got access to a database that enables us to look at company financial information for millions of companies. We did a quick search on that, and we see that if we look at 2021 data, there's roughly about 209 companies that fit that category. But then you need to exclude companies that are regulated financial institutions and companies in the extractive sector. You also need it applies to companies that have this very significant turnover but have profit. So profit as a percentage of turnover or return on sales above 10%. So the most profitable, largest companies, not in extractives or regulated financial services. And that we then whittle down to about 96 companies. Some papers over the years have indicated about 76, so anywhere from, say, 76 to 96 companies at this point in time that it will apply to. the principle is that these really significant companies, they need to look at where their markets are, whether they've got people and whether they've got operations in those countries or not, and they've got to reallocate the profit above this 10% level. They've got to reallocate 25% of that to these various different market jurisdictions. There are some conditions, however. There's always conditions. So one of the conditions with this is that countries that look to implement this, they need to basically agree to give up any digital services taxes. So digital services taxes, or DSTs, they've been introduced by a number of countries, or draft legislation has been introduced by a number of countries to say that if you're a company and you're rendering digital services into our country, we're going to tax you. Now it's interesting that there's various different forms of this. It applies in some countries to certain industries, but not other industries. It applies in different bases. So real proliferation of the way that it's been rolled out. But countries need to agree to forego those DSTs. Another condition that's been somewhat controversial is countries have had to agree to mandatory binding arbitration. So in other words, if there's a dispute that comes up as a result of the reallocation, there's this mandatory binding arbitration. Now the most recent updates have given some concession because emerging countries have said, well, we don't want to be subject to mandatory binding arbitration. So there's certain instances where you can elect to not have mandatory binding arbitration in place. The second element of this, so that's the reallocation of the taxing right. There's this second element which is called Amount B. Now, Amount B seeks to look at companies that operate distribution models across various different countries. And it's intended to give more certainty. So if you fit the mold of a distribution company, in other words, you don't have very significant intangibles and you perform baseline sales and marketing activities, you will then get a targeted return on your results. Now, anyone who's been involved in transfer pricing in any level will know how difficult it is to benchmark and determine what profit a company should make, especially if you're operating in an emerging market. There just is a real lack of comparable data. So that's a big challenge that the OECD has at the moment. How do they go about working out what's the targeted return that these baseline distribution entities should be achieving? There's been a lot of input on that, and there's a lot of work going on behind the scenes, but they basically said by the end of this year that they hope to have more guidance on exactly how that will be implemented. So those are the two elements of Pillar 1, Amount A, reallocating taxing rights of the surplus profit, of 25% of the surplus profit of the world's biggest companies to market jurisdictions, and Amount B saying distributors should get a certain targeted return. The return will differ depending on the different regions of the world that a company is operating in. Pillar 2 is very different. Pillar 2 looks to say, well, in the past, there's been some jurisdictions that have had very low tax rates, and many countries have lost out because companies have set up in those very low tax jurisdictions. Now, it might be that a company in a country has a low tax rate, effective tax rate, for a couple of reasons. One could be the corporate income tax rate is very low. Another reason is there could be government incentives that have been given to a company operating in that particular country. There could be EDZs or special development zones that have been set up to incentivize companies to operate in those areas, driving down the tax rate. And that's the incentive of the country to try to attract people into that. But the view is that other countries have lost out as a result of this tax competition, so to speak. So what Pillar 2 looks to do is to say that, well, every country should have a minimum corporate income tax rate of 15%. So if there's a multinational group that has more than 750 million euros of revenue, and you've got to then look to see all the countries it operates in, which countries is it paying less than 15% effective tax rate in those markets. To the extent it's less than 15%, there's a top-up tax that needs to be paid to the ultimate parent entity jurisdiction. When we look at Pillar 2, now on the screen is just a map of the world. It just basically shows there are very different corporate income tax rates across different countries. Most countries have corporate income tax rates above 15%. What's interesting as a result of these rules is the knock-on impact that it's had in many different countries. So a number of the lower tax jurisdictions have started saying, well, hang on a minute, we are potentially going to lose out in a big way. So take Dubai, for instance. Dubai recently, they've announced that they're increasing their corporate income tax rates, for most taxpayers to 9%. Except for multinationals, that it's going to be 15%. And you can kind of see where those numbers of 9% and 15% are coming in. Sorry, I just remembered, I said earlier on the payments for interest and royalties, they'll look at a minimum of 15%, but on interest and royalties, they look at the tax of 9%. So you need to pay a minimum of tax of 9%. And that's in line with the Dubai tax rate of 9% that's been proposed, and then the higher tax of 15% for multinationals in general. So a couple of interesting observations here when it comes to Pillar 2 is, I'm wondering what's going to be the impact on incentives programs of countries. If countries have said, well, we've got this program and we're going to have an EDZ, so a special zone for encouraging business to come in here, and that's driving the effective tax rate down, well, that's interesting because the country's trying to attract employment, trying to attract business, but now this tax is going to be paid in another country. So the multinational, the investor, is going to be saying, well, hang on, I'm still paying the same amount of tax. I might as well invest somewhere else. So actually, it's not really helping. So will that push these incentives into other forms of incentives, non-income tax incentives? Will it push it into, say, incentives on payroll or on goods, etc.? So it'll be interesting to see how that plays out. So in conclusion, what you can see is we are going through a period of really, really significant global reform. And it's a different set of rules. It's not an arm's length test any longer. It's other taxing rights that are being created. Currently, the benefits of this massive reform are they're either indicating not that significant allocation to developing countries, or in some cases, the impact assessments have not been performed. Countries really do need to consider the impact of these on their incentives programs and how that will play out. It's interesting because the discussions and debate on Amount B, I mean, I gave that example of the characterization of a company and a retailer. Are they in Amount B or not? So there are questions around that. In many ways, it seems like Amount B and Pillar 2 are a bit more stable in terms of the debate and the agreement, but they are unbelievably complex, especially Pillar 2 and Amount A. Another interesting issue will be if countries are not able to levy digital services taxes, are they then going to shift to VAT on electronic services, for example, as a means to raise revenue? Lastly, I think it's really critical to me that there needs to be encouragement and debate on the topic. If that doesn't happen, I can see it. I can see the trend that's taken place over the last several years. There's been a huge increase in the extent of transfer pricing controversy and disputes across the continent and aggression in terms of countries trying to get what they regard as their fair share of tax. And I'm really convinced that if countries do not feel that they've been included in this, there will be a big additional wave of controversy. So briefly, what should companies do and how will this impact my organization? I think first and foremost, please don't hide behind the thresholds. Amount A, yes, it's really significant. It's 20 billion euros, you're either in or out, you can calculate that. That'll come down in maybe 8 years after it's initially implemented to 10 billion euros. Amount B could apply to any company. Pillar 2, that applies to companies that are above 750 million euros in threshold. But remember what I said, the OECD has left the door open for countries to implement income inclusion rules, even if for multinationals headquartered in their country, even if the threshold is lower than 750 million euros. If developing countries are not party to the engagement and discussion, it's very likely to lead to additional controversy across the board for cross-border transactions. If your revenues are above 750 million euros, I'd strongly encourage you to check, can you get the data? One of the groups that I spoke to, they said, they are confident that they will not have any top-up tax that's paid. But the challenge they have is they need to prove that no top-up tax is required. They still need to implement the systems, the very complex system, to be able to prove that it's not going to be paid. If you're paying less than 15% tax in any of your markets, understand, is it incentives, is it low tax, corporate income tax rate, and evaluate what the impact is going to be on your effective tax rate. If you are one of the very large organizations affected by Amount A, your complexity is only going to be that much worse. So try to understand, even if you're a South African subsidiary of a group like that, what's the potential impact and the reallocation. Remember, Amount A, you calculate that and what the reallocation is to the different markets. You then need to consider that reallocation when determining the Pillar 2 consequences. So it's very integrated, all of these analyses, if you're especially a really, really large organization. If Amount A does not go through, then there's a very high risk of the proliferation of the digital services taxes. Last comment is, think about, from your business's perspective, what's the potential impact of this? And communicate early, communicate to stakeholders early, because like that illustration that I mentioned right up front, it will be impacting organizations, especially anyone who's above 750 million euros, and quite likely to have an impact on the ETR of a number of groups.
It would obviously be a boon for infrastructure development on the continent. But if on the contrary, it actually serves either not to address the problem or even to exacerbate the problem, then obviously it creates significant problems for Africa.
There's a couple of markets that wave a flag here in this conversation. They might be in your target also, and Mauritius is a starting point.
Yes, well, Mauritius is an interesting example. I mean, I haven't actually done any work in Mauritius, but clearly, I think Mauritius would be particularly vulnerable to some of these.
Because Michael, surely this. I'm intrigued that there isn't much bigger pushback from Channel Islands, Guernsey, Jersey, Luxembourg, Ireland, which has been a huge beneficiary of. I need to be careful I get the profit shifting. Get it right this time. I mean, this is called the Celtic Tiger because of all of the multinationals heading there for, and we could argue that this is tax incentives, but maybe that's just tax with lipstick put on.
Well, what's interesting, Adrian, is Ireland did push back in the discussions. A number of other countries realized that actually that they need to play ball. So Mauritius has increased their tax rate to 15%. Dubai, as I said, also was 0% corporate income tax, increased to 15%. So in some instances, I think it's probably a losing battle for some of the lower tax jurisdictions. There's just so much momentum, from really significant countries that are pushing this, which means that a number of the lower tax jurisdictions have had to increase their corporate income tax rates.
Why should companies go along with this? Companies, not countries.
Companies, they will need to go along with it because the tax will need to be paid. They need to adapt their systems. If their systems are not ready, well, then there could be penalties, could be other big consequences. Those haven't been all identified, but companies will need to get ready for it. Companies also really need to consider what.
Sorry, just to interrupt you there. So tax penalties are an option. Is jail time an option here?
I don't know. I haven't seen anything about jail time. That's difficult to say.
Could this have criminal implications?
In some countries, there are. I mean, Tanzania. I think the TRA often throw out the statements to say, remember, there could be criminal sanctions. The question is sometimes, well, who would be subject to that jail time? So I think that's difficult. It's more likely to be financial penalties and consequences for businesses, or so that's impactful for businesses.
But Adrian, I'd also think that corporate citizenship and overt corporate morality, as it were, begins to become an important consideration across the world. And it begins to become an intangible that corporates would value, just because of the way that the perception of the market can sometimes drive your commercial interests.
I won't apologize for my cynicism, but these acronyms, GILTI and BEAT, global intangible low tax income and base erosion abuse tax, those acronyms explain human behavior. We change the system, I imagine that the human behavior stays and the system gets a little bit more complex. I think of the infighting that happens in the South African Customs Union, that you've had more than your share, where's ours? Things have changed from when we designed this initially. To me, I'm not convinced that this addresses the source of the problem, which is human behavior, and I am suspicious that this creates more complexity in an already complex system and sets us up for lots of courtroom drama. Fana?
Sure, Adrian. I think the complexity, that's quite obvious. I think most people would react in a similar fashion to the third phase that you showed, with the head blowing off. And I think that might also speak to one of the questions the question that you preceded this one with, which is there going to be a centralization of, is the complexity going to mean that, corporate head office in London or whatever tries to own the problem, or will there be a need to decentralize the TP expertise? And I think without question the inclination will be to centralize initially, but the long-term answer has to be that the expertise has to diffuse across jurisdictions. There's no question about it for me.